Hello class, my name is Dr. B, and today we'll be discussing how to analyze transactions. Throughout this session, we will describe the characteristics of an account and the chart of accounts. We will describe and illustrate journalizing transactions using double entry accounting system. We will describe and illustrate the journalizing and posting of transactions to accounts. I'll show you how to prepare an unadjusted trial balance and explain how it can be used to discover errors. And we will also describe and illustrate the use of horizontal analysis in evaluating a company's performance and financial condition. The first thing I would like to discuss is using accounts to record transactions. As you know, an account is called a record. The accounting systems are designed to show how the increases and decreases of each accounting equation element is separated in a record. Let's take a look at this example from NetSolutions. As you can see on the very top, we have the assets equals liabilities plus equity, which is the accounting equation. Under assets, we have our common assets, cash, supplies, also known as inventory, land. Under liabilities, we have accounts payable, common stock, accounts payable. And under equity, we have common stock, dividends, and then our temporary accounts that have been closed out, such as fees earned, wages, rent, supplies expense, utilities expense, miscellaneous expense. All of these come from the income statement, and once they're closed out for that accounting period, they get transferred to the balance sheet. And as you can see, based off of these transactions, transaction A, it looks like we had issued $25,000 worth of common stock. So we increase our cash for $25,000. We increase our common stock that was issued for $25,000. The accounting equation is still in balance: $25,000 to assets and $25,000 to equity. The next transaction, it looks like we purchased some land for $20,000. We decrease our cash by $20,000 and increase our land by $20,000. The accounting equation is still at balance here because we're only affecting assets and it's equal. And here we'll do a subtotal balance. Our cash balance had decreased by $20,000, leaving us with $5,000. Our land value increased by $20,000, and our common stock value increased by $25,000. As you can see, it's all still in balance. The next transaction, it looks like we purchased some supplies or inventory on account. So for $1,350, supplies increased. We purchased it on account. Account means we received the bill, we'll pay it later. So we increase our accounts payable by $1,350. And if we do another subtotal, our cash balance is currently $5,000. We've increased our supplies or our inventory by $1,350. Our land value is at $20,000. Our accounts payable is at $1,350. We've increased that because we purchased our inventory or supplies on account. And our common stock value remains at $25,000. The next thing that happened, it looks like we made a sale. We made a sale to a customer for $7,500. That's transaction D. We made a sale for $7,500. So, and that sale was made on cash. The customer paid us cash, $7,500. We increased our sales account, which are our fees earned, by $7,500, bringing our cash balance up to $12,500. Our supplies, our inventory account remains at $1,350. Our land is still at $20,000. Our accounts payable is still at $13.50. Our common stock is still at $25,000, but we've increased our sales amount by $7,500. The account is still in balance. So if you were to add these three components up, cash, supplies, and land, and you were to add up accounts payable, common stock, and fees earned, you'll see that they're still balanced, they're still equal. The next transaction, it looks like we paid some employees and we paid some bills. So we decreased our cash by $3,650. To apportion that, we paid our employees $2,125. We paid our rent of $800. We paid our utilities of $450. And we paid our miscellaneous expenses of $275. As you can see, these four items, wages, rent, utilities, and miscellaneous expense, equals that $3,650 in cash that was paid out. The accounting equation is still in balance. And then in transaction F, it looks like we paid some of our bills, some of the things that we purchased on account of $950. So we reduce our cash by $950. We reduce our accounts payable by $950. And again, the accounting equation is still in balance. In transaction G, we decreased our supplies or our inventory, which means we expensed it out because we probably sold it by $800. And so that therefore we recognized a supplies expense of $800 because we sold $800 of supplies that we bought for $800. And of course, if you look at the balances, again, the assets equals the liabilities plus the equity. In the last transaction, transaction H, it looks like we paid our stockholders some dividends of $2,000. So we reduced our cash by $2,000, and we reduced dividends by $2,000. That's the end of that example. Now let's talk about this concept called T accounts. A T account is a visual representation of what happens to each account. Just like every account that we deal with in accounting, on the left side we have debits, and on the right side we have credits. And the T, the top, is the title. The T account, it's shaped like a T, right? The top is the title of the respective account, which is the same name that you'll find in the chart of accounts, and the same name that you'll find in the accounting equation for that respective account. The left side, as I said, represents the debit side of the account. This increases for assets that are recorded on the debit side. So to increase cash, we debit cash. To increase accounts receivable, we debit accounts receivable. To increase our inventory, we debit our inventory. To decrease our assets, like our cash, accounts receivable, or inventory, we credit our inventory. To reduce cash, we credit cash. And here's an example of a cash account. See at the top, we have the name of the account, cash. In the first transaction, letter A, and this is represented going back to our earlier slide from our example from NetSolutions. As you can see, the cash account, if I look at it from a T account perspective, increased 25,000, decreased 20,000, balance 5, increase 7,500, so forth and so on, all the way to transaction H. So going back to our cash T account, in transaction A, we increased it by 25,000. In transaction B, we reduced it by 20,000. In transaction D, we increased it by 7,500. In transaction E, we reduced it by 3,650. Transaction F, we reduced it by 950. Transaction H, we reduced it by 2,000. We can see that the balance is 5,900. That is a debit balance of 5,900. That's what's remaining in the cash account. And you can see that by going back to our example, 5,900 is what was left at the end of all of our transactions. That is the T accounts. Again, the T account is a visual representation of what happens in each account. Now let's discuss a very important topic called the chart of accounts. The chart of account is a list of all of our accounts that we use in our business. A group of accounts for a business entity is called a ledger. The list of the accounts in that ledger are called the chart of accounts. The accounts are normally listed in order in which they appear on the financial statements. The balance sheet of accounts is listed first in the order of assets, liabilities, and equity, just as it appears on the balance sheet. The income statement accounts are then listed in order of revenues and expenses, just as it is on the income statement. Let's talk, what are assets? Assets, as you know, are resources that are owned by the business. These would include things like cash, supplies, which is also known as inventory, intangible assets like patents, copyrights, trademarks. Intangible means I cannot physically touch it, right? Cannot physically touch. I can't physically touch a copyright. I can't physically touch a trademark. I can't physically touch a patent. Tangible assets are things that I could physically touch. These would include things like cash and supplies. Those are physical, tangible assets. Accounts receivable, again, that's what our customers owe us, the business, from the sale of a good or service. Prepaid expenses, these would be things like insurance that I've prepaid for the upcoming year or 6 months. That's an asset because I can cancel that account, get paid back, so forth and so on. Buildings, physical structures, and equipment, like vehicles, machinery, that type of thing. Those are all assets. Those are things owned by the business. Liabilities, as you know, are things owed by the business to outsiders, also known as creditors. These include things like accounts payable. Accounts payable are bills I have received but not yet paid. Notes payable are loans that the business has taken out and has not yet paid back. You can include things like a mortgage, a vehicle loan, or other types of loans that the business has taken out but has not yet paid back. Wages payable. These are wages that the business owes to its employees that has not yet been paid. And unearned revenues. This is cash that I received from my customers, but I have not yet delivered the goods or the service. Now let's talk about equity. Stockholder equity are stockholders' rights to assets of the business. Stockholders' equity is represented by the balance of common stock and retained earnings. Dividends are accounts represented by distributions of earnings to stockholders. What you need to know about equity is it is the difference between your assets and your liabilities. That represents equity. Equity is what the business owners own within the business. Most commonly, you'll see things like retained earnings. Retained earnings are earnings that are retained or kept within the business. Now let's transition from the balance sheet to the income statement. On the income statement, as you know, you'll find your revenues and your expenses. Revenues are an increase in assets and stockholders' equity as a result from selling a service or product to customers. In other words, revenue is what I earn from the sale of a good or service to a customer. That is revenue. Revenues is sales. Similar, right? Revenue is sales. Examples of revenue include fees earned. That's very common in service businesses like an attorney, an accountant, a dentist, a doctor. They all earn fees, right? Fares earned. Think of like a taxi cab. They would earn fares. Commission revenue. A salesperson earns their sales through commission. Rent revenue. If you are a landlord and you rent your home or your business out, you earn rent as revenue. And of course, most commonly would be sales revenue, and that is from the result of selling products, selling goods. Now let's talk about expenses. Expenses are a result of day-to-day operations of the business. And typical expenses include things like wage expenses, rent expense, utilities expense, supplies expense, that's also known as inventory expense, miscellaneous expense, you name it. There's a ton of different expenses. Now let's look at the two together through the chart of accounts. Looking back at our example company, NetSolutions. Assets, we have cash, accounts receivable, supplies, prepaid insurance, land, office equipment. Liabilities, we have accounts payable, unearned rent. Stockholders' equity, we have common stock, retained earnings, and dividends. On the revenue side, we have fees earned. And expenses, we have wages expense, supplies expense, rent expense, utilities expense, miscellaneous expense. The important thing to know here is that every company will have a different set of a chart of accounts because not all companies will use these same assets, liabilities, equity, revenue, and expense accounts. Businesses are different. NetSolutions is an example of a service business. If this were to be a product-based business, the revenue account might be sales revenue, right, as a result of inventory. So it's just something to keep in mind as you're looking at different types of companies. Let's talk about the basis of accounting. We call this the double entry accounting system. Why do we call it the double entry accounting system? It's because we impact two separate accounts with every single transaction. The system is based off of the accounting equation and requires every business transaction to be recorded at least with two separate accounts. The total debits recorded to each transaction must equal the total credits. Again, debits always equal credits. And it has a specific set of rules of debits and credits for recording transactions within the accounts. Looking at the balance sheet accounts, as you know, the balance sheet represents the company's assets, liabilities, and equity. To increase assets, we debit assets. To decrease assets, we credit them. For liabilities, we decrease liabilities by debiting them. We increase liabilities by crediting them. And the same concept applies for stockholders' equity. We debit to decrease equity. We credit to increase equity. As you can see, it is the opposite of assets. The opposite of assets. These signs change on the opposite side of the equal sign. assets. To increase assets, we debit. To decrease assets, we credit. The opposite is true for liabilities and equity, because it's on the opposite side of the equals sign. This goes back to the fundamentals of mathematics. Okay, let's take a look at our income statement accounts. As you know, the income statement has revenues and expenses. The debit and credit rules apply for the income statement based on the relationship with the stockholders' equity. Because as you know, at the end of the accounting cycle, we close out our temporary accounts, which are our revenues and our expenses, and those get closed out to the balance sheet under the stockholders' equity accounts. And of course, they follow the same concept for the stockholders' equity components. What do we mean by this? As we can see with our revenue accounts, to decrease revenue accounts, we debit them. To increase them, we credit them. And for expenses, we increased our expenses by debiting and decreased them by crediting. And of course, these remain in balance under the stockholders' equity component. Looking at a different item, which is dividends. Dividends, of course, must follow similar rules when it comes to debits and credits for recording dividends. And for dividends, to increase dividends, we debit them, and to credit dividends, to reduce dividends, we credit them. These are all what we call the normal balances of the accounts. The sum of increases of account usually equal or greater than the sum or decrease of the account. We call this the normal balance, which is either a debit or credit depending on the type of account it is. Just think of it this way. I normally increase my assets by having a debit balance. My cash normally has a debit balance. That's a way of thinking about it. My cash normally has a debit balance because I normally am positive in cash. So let's go ahead and take a look at that relationship. So looking again at our balance sheet accounts, again, my cash normally has a debit balance. When I have liabilities, I normally have a credit balance for liabilities. I normally have some type of, I normally owe something. So I normally have a credit balance. And in stockholders' equity, I normally have a credit balance. Retained earnings, I normally have a credit balance. And breaking it out by dividends, I normally have a debit balance for dividends. On our income statement, for revenue, I normally have a credit balance. And expenses, I normally have a debit balance. Now let's talk about a very important concept in accounting called journaling or journalizing. Every entry, every transaction that we encounter in business, we must record what we call a journal. That's an entry of that record. So using the rules of debits and credits, transactions are initially entered into a record. We call that a journal. There are a few steps to entering a journal. And this reads from left to right. The first step, of course, is I record the date that the transaction took place or the date that I'm entering that transaction. Typically, in accrual-based accounting, I enter the date in which the transaction occurred. In cash-based accounting, I enter the date of which the cash changed hands. So step one, I enter the date. Step two, I enter the names of the debit account. And that is on the next column, if you will, right next to the date. I'll enter the debit account. And I'll enter the amount right next to that name of that account. Step 3, I'll enter the credit account. That's typically right under, it's the next row down underneath the debit account. It's usually a little bit to the right. And I'll enter the amount to the right of, and just below the debit amount, to the right of. You think of it like your key accounts, right? In step 4, I'll write a brief description of what the transaction is for. And in step 5, I'll do any type of referencing that may be required. This is the process of recording the transaction is called journalizing. The entry of the journal is called a journal entry. And so here's an example of a journal entry. In this example, we deposited a check of $25,000 into our bank account. And we got the $25,000 from issuing the common stock. As you recall, this going back to our very earlier slides, this was the first transaction from NetSolutions. We said it happened on November 1st, so November 1st is the first thing we do. We enter the date. The second thing we do is we enter the debit account. In this case, it's cash. And we enter the debit amount for $25,000. Then we come a line down, or a row down, and we enter the credit account for common stock. We enter the credit amount for $25,000. And then in step 4, we enter a nice note or a reference as to what it was, what we did. We issue common stock for cash. And in step 5, if there's a post-reference number, we'll enter that number in. Post-reference number, think of it like your checking account. If you physically write checks on your ledger, you'll see that there are reference numbers. Those are check numbers, right? And that would be typically entered for the in the post-reference column. And just for reference, as you can see from the chart, from the T accounts and the accounting equation, the accounting equation is still in balance. We debited our cash, we increased our cash for $25,000, and we increased our equity by crediting our equity for $25,000. $25,000 equals $25,000. The accounting equation is still in balance. Okay, so let's take a look at some transaction terminology. So transaction terminology is a representation of what happened and how it impacts our debits and credits. So when we received cash for services provided, we received cash, which means we debited our cash for services provided, which means we made a sale of services. We credit to increase our sales account. So our sales account, we credited it to increase our sales, and we increased our cash by debiting our cash. In this next transaction, we provided services on account, which means we sold our services on account. We increase our accounts receivable because it's on account, which accounts receivable means we provided the service but have not yet been paid from our customer, right? So we increase our debit account, and in this case, accounts receivable. In our credit account, we increased our sales account, fees earned. The next transaction, we received cash on account. This means our customer finally paid us. for the services we provided to them, but they had not yet paid earlier. Now in this case, they're actually paying us. So we increase our cash by debiting our cash, and we decrease our accounts receivable because we're being paid. So we decrease our accounts receivable to increase our cash. In the next transaction, we're making a purchase of something, of maybe equipment on account, meaning we're gonna purchase now, but we're gonna pay them later. So we increase our asset account, which could be our equipment account, and we will increase our accounts payable by crediting our accounts payable account. And now we're going to make a payment on that equipment that we purchased earlier, but we haven't paid it yet, but now we're going to actually pay it. So we're going to pay on account. So we're going to decrease our accounts payable by debiting our accounts payable, and we're going to decrease our cash by crediting our cash. In our next transaction, it looks like we are paying for our equipment, or we are paying for one of our expenses, maybe a utility bill or something. We're going to pay that in cash. So it says paid cash is the transaction. We're going to debit our asset or our expense account, whichever one it is, and then we will credit our cash to reduce our cash. In the next transaction, we're going to issue some common stock, which means we're going to increase our cash because we're issuing common stock, increase our cash by debiting cash, and we'll also increase our common stock account by crediting common stock. And then our last transaction, we're going to pay some dividends. So we will increase our dividends account by debiting our dividends, and we'll credit our cash to reduce our cash amount. And of course, as you know, these transactions, sorry about that. These transactions follow our earlier example as well. So going back to, looks like the second transaction from our earlier example, NetSolutions. On November 5th, we paid $20,000 for the purchase of land for a future building. So again, to record the transaction, November 5th was the date. Our debit account is land. We're going to increase our land account. So land, we're going to debit land by $20,000. We're going to, and then the next entry is cash. We're going to credit our cash account because we paid cash for the purchase of the land. So cash is our credit account for $20,000. And then the note is purchased land for building site. And if there was a reference number, we would enter that as well, like if we paid it with a check. Okay, and then of course, looking at the accounting equation impact, we're only impacting two asset accounts. We debit our land account for $20,000, and we credit our cash account for $20,000 because we paid it in cash. The accounting equation is still in balance. Why? Because we're increasing our land account, decreasing our cash account. Both are assets, so this is kind of like how you would call, we're netting out. We're netting out the assets, increasing asset and decreasing asset at the same time, right? So the accounting equation is still in balance because the other two are not being impacted. We're increasing asset and decreasing asset at the same time. The other side of the equation is not being impacted. Let's look at the third transaction from our earlier example. We purchase supplies on account for $13.50. So we are going to debit, of course, record the date first. We're going to debit our supplies account for $13.50. We bought it on account. Anytime that you see the word on account, please know that we're either going to use accounts payable or accounts receivable, depending on what the transaction is. In this case, we're purchasing supplies or inventory on account. So we debit our supplies or our inventory, $13.50. We credit our accounts payable account to increase accounts payable by $13.50. We make the note, purchase supplies on account. And this course, there is no check taking place, so there's no reference number. And then looking at what the impact is on the accounting equation, we increased our supplies or our inventory by $13.50. So we debit the asset of supplies $13.50, and we credit the accounts payable liability by $13.50. So $13.50 equals $13.50. That is the impact on the accounting equation. Let's look at the next transaction in sequence. Transaction D. November 18th, we received cash from our customers for services that we provided to our customer. So again, we record the date, November 18th. The debit account is cash. We're receiving cash. So debit cash, $7,500. The fees earned, this is our sales account. We credit our sales account, which is under stockholders' equity, for $7,500. We make the note, receive fees from customers. We look at the accounting equation. We increased our assets, our cash, by debiting $7,500 for cash. And we increased our sales account, which is fees earned, under stockholders' equity, which is a revenue account, by $7,500. Pardon me. Increase and increase. So therefore, we see that the accounting equation is still in balance for $7,500. Looking at transaction E from our earlier example, on November 30th, we recorded a bunch of expenses, as you recall. We paid our employees for $2,125. We paid rent for $800. We paid our utility bills, which is like our electric and our internet and our water and cable and whatever, for $450. And we recorded some miscellaneous transactions for $275. Miscellaneous transactions could be things like office supplies, things like paper and pencils and printers, ink, and so forth and so on. That's miscellaneous expenses. And so to record that transaction, we have November 30th, the date, wages expense, rent expense, utilities expense, miscellaneous expense. These are all our debit accounts because those are all of our expenses. We need to increase them. So we debit our expense accounts. $2,125, $800, $450, $275, and then we credited our cash by $36.50. You can see that the $36.50 is the same amount if you add up the wage expense, rent expense, utilities expense, and miscellaneous expenses together. These all equal $36.50. So your debits always equal your credit. And there's no limit to the number of debits and credits that you can have in one transaction, just so you know, as long as the debits and credits equal. And so looking at the accounting equation impact, we credited our cash, $36.50, because we paid cash for our wages, rent, utilities, and miscellaneous expenses. And as you know, all of these expenses fall under stockholders' equity when the accounts get closed out in the accounting cycle. And so the accounting equation is always in balance. Looking at the next transaction on November 30th, the company paid our creditors $950. Now, again, our creditors are the people that the company owes for the purchase of things like inventory, right? So we are going to reduce our accounts payable and reduce our cash. To do that, November 30th was the date. We debit accounts payable to reduce accounts payable by $950. And we reduce our cash by crediting our cash, $950. And our note is paid creditors on account. How did we impact our accounting equation? We have assets. We reduced our cash asset, $950, and we reduced our accounts payable by debiting accounts payable, $950. 950 equals 950. The accounting equation is still in balance. Looking at the next transaction, we purchased $1,350 of supplies on November 10th. We determined that the cost of the supplies on hand was $550. Thus, we are going to record $800 worth of supplies that were used during that month. This type of transaction you could consider to be a adjusting entry, because we are recognizing that we used this amount of the supplies during that particular month. So if we used up $550 of supplies at the end of the month, that means that was the amount that was left over at the end of the month. That means we used $800 during that month. So we would make a record November 30th supplies expense for $800, and then we would credit our supplies account for $800 to represent the supplies used during that month. So our asset, we would reduce our supplies by $800, and we would also impact $800 for the supplies expense, increase our supplies expense by $800 under stockholders' equity. And then the last transaction from that series of transactions that we started over toward the beginning of this session, we paid out dividends to our shareholders of $2,000. Now, to do this, of course, the date was November 30th. We debit our dividends account by $2,000. We credit our cash by $2,000 because we paid it out in cash. The note is paid dividends. How does it look on the accounting equation? We credited our cash or reduced our cash by $2,000, and we increased our dividends account by $2,000. Okay, so what is posting? So posting of journal entries to accounts. This is the process of transferring debits and credits from the journal entries to the accounts. We call that posting accounts. Okay, so looking at another example, on December 1st, the company paid a premium of $2,400 for insurance policy for liability, theft, and fire for 1 year. This is prepaid. In most cases, we prepay our insurance. In other words, we're paying it before we're going to use it or before we're going to consume it. So on December 1st, the company is going to pay for the following year. Okay, pay for the following year. So this will cover January 1st through December 31st of the next year. So we're going to pay $2,400. What does that transaction look like? We debit our prepaid insurance, which is an asset account, for $2,400, and we are going to credit our cash of $2,400, and the note is paid the premium for 1 year policy, and there's a couple of reference numbers here. The reference numbers here are tied to the number of the account on the chart of accounts. Prepaid insurance, that account number is 15. The cash account number is 11. As you can see, it's referenced here below. When you look at the accounting equation impact, we see assets cash, the number 11 is shown in the right corner, because cash is the 11th account number on the chart of accounts. We credited our cash for $2,400 by reduce our cash, and we increase our prepaid insurance account for $2,400. They're both asset accounts, and so the accounting equation is still in balance. And this represents the steps that we took to record that transaction. Debits and credits for the journal entry are posted to the accounts in order which they've occurred. The debit portion on this, so on the previous slide that I just showed you, here are the steps that we took. We first recorded the date. We then recorded the debit account, which was prepaid insurance for $2,400, and then of course the credited account, which was cash for $2,400. On step 3, we recorded the reference numbers. I'm sorry, we recorded what it was for, and in step 4, we recorded the reference numbers, 15 and 11, respectively. This kind of breaks it down step by step. As you can see here, step 1, we recorded the date. Step 2, we recorded the debit and credit accounts and numbers. And in and then you can see the transference of how it flows, right? How it flows to each respective account. This account is prepaid insurance. The account below is cash. We debit, meaning we increase the prepaid insurance account. We credit the cash by reducing our cash account. Step 3, we recorded the reference numbers. And as you can see, those reference numbers correspond. And then step 4, we record the reference numbers for the respective account numbers, right? Prepaid insurance is account number 15. The cash account is account number 11. So that's just a nice visual representation of breaking it down. Now, what about prepaid rent? As you know, every month the company pays rent. So on December 1st, we paid rent for the month of December of $800 for renting the office space. And the payment is due the first of every month. So December 1st, rent expense, which is account number 53, for $800. We credit our cash to reduce our cash by $800. Cash, as you know, is account number 11. And this was to pay rent for December. Our accounting equation, cash, which is account number 11, we reduce our cash by $800. We did that on December 1st. And we increased our rent expense account by $800 on December 1st. Rent expense is account number 53. What about unearned revenue? Unearned revenue. That means our customer paid us, but we have not yet provided the service or the selling of the good. So in this example, on December 1st, we received an offer from a local retailer to rent land purchased on November 5th. Retailer plans to use the land as a parking lot for employees and customers. The company agreed to rent the land to the retailer for 3 months. And then the retailer prepaid the rent to us, the company, for it looks like a few months, right? For 3 months, $360, beginning on December 1st. So on December 1st, we record the transaction for unearned revenue. In this case, unearned rent it's the same as unearned revenue. It's just a different accounting. So December 1st, we received cash for $360. Cash, as you know, is account number 11. Our unearned rent account is account number 23 for $360. This is received advance payment for 3 months of rent on land. Our company, NetSolutions, is renting land to another company, and that company is paying us the rent. They paid us 3 months in advance. That's kind of a breakdown of this transaction. What does it look like on our accounting equation? We increase our cash, debit our cash 360, and we are going to credit our unearned rent account, which is a liability account, for 360. It's a liability because the customer paid us for they prepaid us. When they prepay us, it's a liability until it becomes an equity, which is a sale, right? It becomes earned at the time that it's incurred, right? So as those 3 months go by, we would move it from a liability to an equity because it's being incurred during those months. Okay, another example, December 4th, our company purchased some office equipment on account. Again, when you see on account, you know you're going to be impacting either accounts payable or accounts receivable. In this case, it's receivable because we're purchasing equipment that we will use at some time in the future, and we're doing that on account, okay, from this company called Executive Supply Company for $1,800. So we are going to debit our office equipment for $1,800. As you know, that's an asset. Office equipment is an asset. That's account number 18. We're going to credit our accounts payable account by $1,800 to increase our accounts payable. Accounts payable, as you know, is account number 21. This transaction was to purchase office equipment on account. That's the note. Okay, so we impacted our assets and liabilities. We debited our office equipment for $1,800. We credited our liabilities for $1,800 to increase both, and the accounting equation is still in balance. Let's look at another example. We're going to pay for advertising. The company pays for advertising. December 6th, we bought some advertising for $180 from a newspaper advertisement. This particular company does not have a line item for advertising expense, so we call it miscellaneous expense. December 6th, miscellaneous expense. We debit miscellaneous expense to increase it for $180. We paid cash because it did not say anything about on account. When it explicitly says on account, we know that it's accounts payable. If it does not say anything about being on account, use cash as that account. So miscellaneous expense, $180. We credit our cash, $180. And the note is paid for newspaper advertisement. We credit our cash, reduce our asset, $180. We increase our equity, miscellaneous expense, $180. The accounting equation is still in balance. Next example, December 11th. We paid creditors for $100. This means we're paying our bills, right? So we reduce our accounts payable by debiting our accounts payable for $100. We credit our cash to reduce our cash, $400. The note is paid creditors on account. They happen on December 11th. Here are the respective account numbers. The accounting equation, reduce cash, $400. Reduce our accounts payable by $400 under liabilities. The accounting equation is still in balance. Another example, we are paying our employee, our receptionist, and a part-time assistant $950 for 2 weeks of wages. To do that, we are going to debit our wage expense by $950. It looks like we're paying them straight away, so we're going to credit our cash, $950. And this is to pay our employees for 2 weeks worth of wages. Again, we reduce our cash, $950. That's reducing our asset, $950. And we increase our wage expense by $950. The accounting equation is still in balance. Another example, we are receiving cash from our customers. $3,100 we're receiving from our customers. December 16th, we received $3,100 from our customers. So debit cash, $3,100. And we are going to credit our fees earned to show an increase in our revenue of $3,100. Received fees from customers is the note. The impact on the account, we debit our cash to increase our cash $3,100, and we are going to credit $3,100 for fees earned to increase our revenue. Okay, so what to know about that account, about that transaction? When a business agrees that a customer may pay for services provided at a later date, we call that an accounts receivable. In other words, if I provide the good or service to my customer and I say, hey, customer, you can pay me in 30 days or some other specified date in the future, the company creates an accounts receivable, and then the customer, which is called a claim against that customer for that amount. The customer then pays us that amount at a later date. So we increase our accounts receivable account to represent what the customer owes us. We'll then reduce the accounts receivable account when the customer actually pays us the cash. Accounts receivable is an asset account, and the revenue is earned even though the cash has not yet been received. Okay. So what does that look like? Fees earned $1,750 for the first half of December. So December 16th, we increase our accounts receivable $1,750, and we increase our sales account $1,750. Fees earned on account. So the asset account, accounts receivable, we increase that by $1,750, and we increase our sales account $1,750. Accounting equation is still in balance. Okay, next example. I'm going to pay some bills on December 20th. Company pays some bills, $900, for that equipment that we had bought earlier. Remember the office equipment that we bought earlier? We owe them $1,800, but at this time I'm only going to pay them $900. I'll pay the balance at a later date. It's okay. They said it's all right. So I'm going to reduce my accounts payable by $900 and reduce my cash by $900. How do I do that? On December 20th, I debit accounts payable by $900 to reduce my accounts payable, and I debit my cash by $900 to reduce my cash. The note is I paid my creditors on account. Of course, the two respective account numbers. I am crediting my cash because I'm reducing my cash by $900. I'm debiting my accounts payable to reduce my accounts payable by $900. The accounting equation is still in balance. Next transaction, December 21st, I received $650 from customers in payment on their accounts. So now I'm collecting from my accounts receivable, right? So I debit my cash to increase my cash by $650. I credit my accounts receivable to reduce my accounts receivable by $650 to represent received cash from customers on account, the respective account numbers, the date. Under assets, because both cash and accounts receivable are assets, I increase my cash by $650 and reduce my accounts receivable by $650. The accounting equation is still in balance. I'm netting out my assets. The next transaction, I'm paying for supplies. So I'm paying cash for supplies that I'm purchasing on December 23rd for $1,450. I increase my supplies or my inventory account by $1,450. I decrease my cash by $1,450 to represent purchase supplies on December 23rd. Here are the account numbers. As you know, supplies or inventory is an asset account. I'm going to increase my asset account or my supplies account by 1,450. I'm going to reduce my cash, which is an asset account, by 1,450. The accounting equation is still in balance. I'm netting out my assets. Another example transaction, I'm paying my employees. I like to do that from time to time. I typically do it every 2 weeks. I'm paying my part-time employees $1,200 for 2 weeks worth of wages. I increased my wage expense by $1,200. I decreased my cash by $1,200 on December 27th. Here are the account numbers. The transaction is paid 2 weeks worth of wages. I decreased my cash by $1,200. I increased my wage expense by $1,200. The accounting equation is still in balance. I'm now going to pay a telephone bill that I received earlier in the month. On December 31st, I'm going to pay $310 for a telephone bill that I received for that month. Utilities expense is the account for my telephone bill, $310. I'm going to increase my utilities expense for $310. I'm going to reduce my cash amount, $310, to represent paying my telephone bill on December 31st. Of the accounting equation, I reduce cash, $310. I increase my expense, $310. The accounting equation is still in balance. Now I'm going to pay an electric bill for $225 for the month of December. I increased my utilities expense, $225. I decreased my cash, $225, to pay the electric bill. As you can see, the utilities expense is not just one utility. It includes things like electric, water, internet, whatever, right? It could telephone. It could be a number of different things. It could be a number of different utilities. So increase utilities expense, $225, decrease cash, $225, to pay the electric bill on December 31st. I'm sorry. The accounting equation is still in balance. Decrease cash, $25, increase utilities expense, $225. Also, at the end of the month, I received $2,870 from my from sales that I made to my customers. I debit my cash, $2,870, to increase my cash. I increase my sales, or my fees earned, by $2,870 to represent received fees from customers, or receive sales I made and received cash from customers. Increase my cash, $2,870. I increase my sales, $2,870. The accounting equation is still in balance. I also made some sales on account. Made sales on account. So on account means accounts receivable. When we're talking about sales, when we're talking about sales, it's accounts receivable. December 31st, I made sales on account for $1,120. So December 31st, accounts receivable. To increase accounts receivable, I debit accounts receivable, $1,120. To increase my sales, I debit my sales account, which in this case is fees earned, $1,120, to represent fees earned on account. I debit accounts receivable, $1,120. I credit fees earned, which is my sales account, $1,120. The accounting equation is still in balance. In this example, I'm going to pay dividends to my shareholders of $2,000. I'm going to debit dividends by $2,000. I'm going to credit cash by $2,000 because I'm paying in cash. Represent pay dividends on December 31st. Here are the account numbers. I'm crediting cash because I'm reducing my cash amount, $2,000. I'm going to increase my dividends account by $2,000. The accounting equation is still in balance. Here's the general ledger for our company. As you can see, the dates I've impacted my accounts. The post reference, these are your account references, the amounts, so forth and so on. This is for cash. This is for accounts receivable. This one's for supplies. This one's for prepaid insurance, land, office equipment, accounts payable, unearned rent, common stock, and dividends. Think of your general ledger accounts as the list of the transactions for each account. The ledger represents for each account. And this is just a continuation: fees earned, wages expense, supplies expense, rent expense, utility expense, and miscellaneous expense. You can see each date that that account was impacted, the reference to that respective account, that respective transaction, the amounts, and so forth and so on. And this represents the balance of that account. So let's talk about the trial balance. A trial balance is the equality, the equivalence of debits and credits in that ledger that should be proven at the end of each accounting period by preparing a trial balance. There are a couple of steps to follow when preparing a trial balance. First is list the name of the company, the title of the trial balance, the date of the trial balance. The second step is list the accounts from the ledger, enter their debit or credit balances. The third step is the total debit and credit columns of the trial balance. The fourth step is to verify the total of the debit column equals the total of the credit column. The unadjusted trial balance is distinguished from the adjusted trial balance and post-closing trial balances. What does a trial balance look like? In step one, name of the company, unadjusted trial balance, the date the trial balance was created. I list out all of my accounts, and again, it's in the same order. So your balance sheet accounts, and then of course your income statement accounts toward the end. The account numbers, whether it held a debit or a credit balance, and then as you can see, as you total them both up, they should be equal. Your debit should always equal your credits. Okay, so what happens when there's an error? A transposition occurs when the order of digits is copied incorrectly. So transposition error means I accidentally typed it in wrong. That's what that means, right? Such as writing 542 instead of 452. That's very common, especially when you're typing very quickly. Another type of error is called a slide error. This is the entire number is copied incorrectly, such as I put in too many digits, right? Errors that do not affect the trial balance, but they could have other impacts. Errors that do not cause trial balance totals to be unequal, but may be discovered in preparing the trial balance, such as if there's a negative supplies account, that means I must have entered a credit instead of a debit, that type of thing. If it's already been journalized, you can enter what we call a correcting journal entry. So here's an example. On May 5th, 12,500 purchase of an office equipment on account was incorrectly journalized and posted as a debit to supplies and a credit to accounts payable for 12,500. The entry to correct the error that we would need to enter is office equipment 12,500 and a credit to supplies 12,500. So in other words, I accidentally called it supplies instead of office equipment, right? So in order to correct that, I simply reverse those two accounts, and then I make an entry as to what that correction was for. So what is horizontal analysis? Horizontal analysis is the amount of each item of the current financial statement compared to the same item from an earlier statement. So an example would be, I'm going to take my 2020 rent expense account and compare that to my 2019 rent expense account to look at the differences between those 2 years. I'm analyzing that same account over a period of time. I'm comparing my income, my my income statement of 2020. I'm comparing that to my income statement 2019. I'm looking at the same exact expenses, rent expense, 2020 compared to 2019. What are the differences? Was there an increase or a decrease, and why? By what percentage was the increase or decrease? That's the point behind horizontal analysis. It helps me as a manager to better manage my expenses. Yeah. When two statements are being compared, earlier statement basis for computing the amount is a percentage change. So here's an example, year 2 compared to year 1. For this particular company, it's a lawyer. Lawyer made more sales. Their sales increased. That increase was by 25%, as we can see. The I'm sorry. The expenses, our wage expenses increased by 15,000. That increase represents 33% of all of our expenses. Rent expense went up slightly, 3,000. Rent expense attributes to 25% of all of our expenses. Utilities expense went up 3,500. That represents 38.9% of all of our expenses. Our supplies expense decreased by $300. That's a decrease of 10%. Our miscellaneous expense increased by 500. That represents 27.8% of all of our expenses. Our total operating expenses represents 30.6% of our business. Our net income increased by 15,800 from year to year, representing 19.9% of our business. Now, how did I get 25% of fees earned? I took our difference, 37,500, divided by our year 1 of 150,000 to get 25%. That's how you get your percentage. You take your revenue in year 1, you take the change from year 2 to year 1, divided by year 1's revenue to get your percentage. That's how you get a percentage. And that is analyzing transactions. Thank you for watching. If you have any questions, please feel free to message me, email me, call me, make an appointment with me, get a hold of me. I'm here for you. And I hope that the semester is going well for you so far. Thank you so very much for watching. I'm looking forward to our future interactions. Thank you.